Thank you for downloading this video. In the next few minutes, we want to introduce you to a new concept in accounting and risk management. We call it risk accounting. You may be surprised to learn one rather alarming fact about banks. Although their business is about accepting risks for a return, banks can't tell you how much total risk they've actually accepted. They simply don't have the systems that can do this. If banks can't account for the total risks they accept, it becomes virtually impossible for their boards and senior management to anticipate where losses are likely to occur so that they can take timely action to prevent them. The financial crisis of 2007-08 gives us a prime example. The first indication that banks were engaging in excessive but unreported risk-taking was when those risks turned into losses which, in many cases, were large enough to trigger the failure, government bailout, or forced acquisition of banks of all sizes all over the world. The amount of risk banks typically carry, both financial and operational, has grown massively over little more than a generation due to four principal reasons. First, phenomenal advances in technology, the so-called digital revolution. Second, escalating business consolidations through successive mergers and acquisitions and the emergence of the megabank. Third, an operating dependency on globally interconnected electronic data and information networks. And fourth, the proliferation of sophisticated and highly complex risk intermediation products such as the derivative, the synthetic, and the structured product. Risk accounting is a breakthrough solution that tracks, aggregates, and reports all types of risk, both operational and financial, from the very moment risk is created across banking enterprises of any size or complexity. Risk accounting is the result of more than 10 years of research and development involving practitioners and academics. So what is risk accounting? Before we start looking into what it does and how it does it, we first need to invite you to join us in some revolutionary, out-of-the-box thinking. Risk accounting identifies, quantifies, aggregates, and reports risk data relative to all risk types: credit, market, liquidity, conduct, interest rate, and operational, from across the entire enterprise. For that to be possible, we have devised a common and universal risk exposure measurement method which is at the core of risk accounting. We'll show you how that works in a few minutes. Any common and universal measurement system needs a common, standardized unit of measurement. So we've created a brand new additive risk metric, a common, standardized unit of risk measurement unique to risk accounting that we call the risk unit, or RU. Banks can quantify and aggregate the risks they accept, both absolutely and in comparison to others, by using this new risk metric. Three types of lookup tables contain the key risk attributes of all the products offered by a firm. The first is the total amount of a product's new or incremental business generated on a day-by-day basis, or the associated risk positions at a particular point in time. These come via interfaces from the product systems that post to either the general ledger or its subledgers. This daily amount of new business or point-in-time position values are mapped to what we call the value table that gives us the applicable value band weighting. Second is the inherent riskiness of each product. Product experts assign risk weightings to each product. We call these risk weightings exposure uncertainty factors, or EUFs. Third is the risk mitigation effectiveness of each component within the enterprise that interacts with the product on its journey along its particular end-to-end processing cycle. When we say components, we mean the operations departments, reference data master files, automated systems and risk management functions that handle or interact with the product. From the risk weightings extracted from the 3 tables, risk accounting calculates 3 metrics that are tagged onto each transaction the moment it is posted in the general ledger. First is the inherent risk, which is the risk-weighted size of a transaction expressed in RUs that represents the transaction's maximum potential for loss. Second is the Risk Mitigation Index, or RMI, which is a dynamic measure on a scale of 1 to 100, where 100 is best practice that represents, in percentage terms, the portion of maximum potential loss that is mitigated through the effective management and control of the firm's operating environment. Third is the Residual Risk, which is also expressed in RUs that represents the probability of loss. Residual risk is the portion of inherent risk not covered by effective risk mitigation, represented by the Risk Mitigation Index. With these 3 metrics now tagged permanently onto each transaction, we have the ability to aggregate RUs to produce an enterprise risk dashboard with drill down to the detail, which can be organizational, including by business line, by location, by product, by customer, by legal entity, and so on. Thank you for taking the time to watch this video. On this slide are details of who you can contact to obtain more details on risk accounting and how you can implement it in your organization. So why not give them a call or send them an email?